the YouTube algorithm versus the Forex algorithm. Now here we're talking about, in today's digital age, sophisticated algorithms are the unseen architect shaping our daily experiences, from the videos we watch to the financial transactions that power the global economy. Now you have to understand that we have large language model of algorithms that help make things easier for the globe. Now these are the kind of technology that YouTube employs. You know, YouTube with over 2.7 billion monthly active users and 1 billion hours watched daily stands as a testament to algorithmic influence in digital consumption. Simultaneously, the forex market, averaging an astonishing $7.5 trillion in daily trading volume, showcases that's the forex market rather, sorry, showcases the critical role of algorithms in high-frequency financial markets. Join us as we unravel the power and impact of these algorithmic forces. So, YouTube algorithm, decoding content discovery. Now, YouTube's algorithm is meticulously designed to maximize viewer satisfaction and watch time. It analyzes a vast array of signals to recommend videos that are most likely to keep users engaged on the platform. The personalization is key to its success, with an estimated 80% of all YouTube views originating from its powerful recommendation engine. Now, the YouTube algorithm is built in a way that it looks at what your interest is, what is your last search, what was like the last videos you watch, what are the things you like to watch, are they comedies, educational content, and what kind of education. So it automatically brings up those things for you. That's why I said there's an estimated 80%. Like the 80% of views are actually attributed to the algorithm. So people now see like, so they move from a place where they are now more interested in trying to meet your personal desire or what they think is your personal desire. So the algorithm, sometimes YouTube actually even listens to your conversation, and then you come to YouTube, you actually see, because when you go to your phone setting, your device setting, you see all these settings like can we have access to your mic and all of those stuff. So you could say something and you come online or you enter YouTube, you are seeing those things there, so they try to use algorithm to look at the patterns you follow, the things you watch. Now from there, the algorithms are looking at a particular cycle to see, okay, see what I'm going to recommend, what I'm going to recommend for you, thereby satisfying your individual need. Now, the YouTube's algorithm impact and revolution. Pre-2012, we look at views focus. The algorithm prioritized raw view counts, leading to clickbait and short high-frequency content. Then in 2012, we advanced to watch time emphasis. Then we moved to satisfaction and quality. Now we go to creator economy boom. Now trends and niche communities. Then these are the eras when it comes to like YouTube. Now we had a place where it was like, what is most viewed? The algorithm just keep bringing it out for people, keep bringing it out for people, and then all of that, So in 2012, we're looking at watch time, what are people like engaging more in, all of that, like what are people like, what was able to retain viewers. So in 2012, they were like evolved to a place where like it's about like the quality of the content, what is more relevant and all of that, to where we got to a place where we refined the algorithm was refined to now get to a place where like it's about what are people more interested, what's an individual, not now it not individualize the system. It's not a place where like you look at what do people generally want to see, but it's about like what's the individual interested in. Because if the algorithm just keep bringing for me like, let's say, a particular trendy comedy and I just want things that are educational, I start to lose interest. So they have to now individualize everything. So a case study, let's look at Mr. Beast. You understand? The monumental success of creators like Mr. Beast is heavily attributed to their mastery of content optimized for algorithmic distribution, resulting in massive reach and engagement. So you have to really understand, how does this algorithm work? for you to be able to thrive on YouTube. Like, you have to understand, how does this algorithm work? So, okay, how do I create something that, is appealing to almost every individual? Or how do I distribute my content in a way that, every individual have something out of my content that will be appealing to them? So that's why you have all these playlists and all of that. So let's move forward. So let's look at institutional forex, the $1 trillion battlefield. The foreign exchange or forex market stands as the largest and most liquid financial market globally, averaging an outstanding $7.5 trillion in daily trading volume, according to the Bank of International Settlements in 2002. This immense scale makes it a critical component of the global financial system. Key participants include the central bank, large investment banks, agile hedge funds, and multinational corporations. So we're just trying to look at the foreign exchange market briefly and what it's all about. Now you look at the anatomy of forex trading algorithm. It has real-time data feeds. So algorithm ingests colossal volume of market data, including price quotes, news events, and economic indicators, all in real time. So these algorithms are actually trained. So they are trained to actually understand like data events. Now we have algorithms now that try to interpret economic data, news events, and all of that. We have those algorithms now. So it didn't start now. We're just having this breakaway where like we're now having it accessible to like common people. We'll have this large language model algorithms that they can be able to like interpret news events. They can look at economic indicators. They can look at so many things and then make a decision without human interference. So they can predict, that will have predictive analysis and analytics. So advanced machine learning models analyze historical and live data to identify patterns and predict future price movement. So they understand how to look at what has happened before, identify like patterns and then act out of those patterns. So like the large language model, you can't tell them what to do. They are actually built to actually think for themselves, if I'm to use the word. So they study the human patterns, which is linked to our emotion, which I'm going to get to. So they now from there are able to predict future price movement. They look at data that they have been fed with, still being fed with, to really understand and be able to predict the market. So strategy execution strategies like high frequency trading, arbitrage, and statistical models are implemented to capitalize on market inefficiencies. So automated execution, trades are executed automatically, often within milliseconds, to seize fleeting opportunities and manage large orders effectively or efficiently. Latency critically. So milestone level execution is paramount. Even tiny delays can result in significant financial losses in this hyper competitive environment. Now you have to understand that these machines are fed with this information, so they are actually like built in a way that it's a high frequency trading algorithm. So it automatically places a position and makes sure that the amount of volume it places will be able to be filled. So it's fast in milliseconds. Now, if a news is dropping, before you are engaging, this thing has been able, just like go to your any algorithm that you use, any AI that you're using, and then just put in an information. You see how easily and fast it produces the information for you. That's the same way these algorithms work. This high big institutional algorithms, this is how they work. So automatically they are in there, they have interpreted the data automatically, they are taking a position, everything in milliseconds. This is how these algorithms are. This is how efficient that they are. So automation and predictability, data driven call. So both YouTube and Forex algorithm rely on analyzing massive data sets to identify patterns. YouTube uses behavior data, while Forex algorithm analyze market data. Algorithms in both domains are designed to anticipate future events. YouTube predicts what content the user will watch next, and Forex algorithm predicts market movements. Both systems employ continuous learning, YouTube's algorithm adapts based on user engagements, while Forex algorithm refines strategies based on trade outcome and market shifts. Performance is continuously optimized. YouTube uses A/B testing to improve recommendations, while Forex algorithm rely on backtesting and simulations to refine trading strategies to maximize profitability. Now, you look at both. The primary goal of YouTube algorithm is to maximize user engagement and advertising revenue. Now that of Forex, the institutional Forex algorithm, is to maximize profit and to have a meticulous risk management in a financial trading. For YouTube, it's more like for spreading informations and all of that. For the key risk. Let me look at the key risk. So it's creation of echo chambers, spread of misinformation, and potential of for additions. So we know that is something that is like, for instance, like if you have been training for a while, there was a time that an AI image was generated of, I think, the World Trade building seemingly to be burning or something like that, and you could see how market just reacted to that misinformation ASAP. And the algorithms, they are not human, so like they are not perfect, so they automatically are pushing all these things that like people that were into, like the individuals that were into like looking up for things, whether on X, on Instagram, or wherever, or YouTube or Facebook, looking at a particular set of, let's say, economic news and all of that, the algorithm pushed these things to them. So they were not in the business of trying to cross-check whether it was right or wrong. Everybody started reacting. You get? So for these algorithms for Forex, the key risk is susceptibility to flash crashes, potential for systemic risk, and market manipulation concerns. Now, if you look at there are some people in history that have used these algorithms and has been actually been arrested, jailed for issues like this in the past. So and all of that. So they have their own risks and all of that. Now, algorithms have undeniably cemented their central role in both our digital consumption habits and the complex machinery of global financial market. As technology continues to advance, we can anticipate even greater integration of artificial intelligence and machine learning, with deep learning models driving increasingly sophisticated predictive capabilities. I actually want to go further by explaining some things, that I actually wanted to achieve with this presentation. I just wanted to let you guys understand the similarity between the YouTube algorithm and the Forex algorithm. Now, these things are built to predict human emotions. Now, algorithms exist. For people that think, oh, there is no algorithm in the Forex market, algorithms exist. Now, big institutions use algorithms. Now, algorithms can move the market in a smaller time frame more efficiently and effectively because of the amount of money that flow. Some big institutions are not able to actually move the market much. Now, but there is a possibility that if all the algorithms by big institutions tag along on a particular direction, it could substantially move the market. Now, but that is why I always say fundamentals move the market and not technicals, because these algorithms, they're out there looking at data, they're out there looking at news events, so they are tagging along. Now, quite alright, you might not be able to be as fast as they are, but you can tag along also if you understand this thing. They're not looking at trend lines and all of that. They're not built that way. You understand? We have two types of algorithm. We have the white box algorithm and the black box algorithm. We have the ones that if this happen, do this, if that happen, do that. That is the white box algorithm. Then we have the black box algorithm, which are actually built with large language or complex language models. These things are they are built to be predictive. They're not there Or if you see resistance, sell. If you see support, buy. If you see a flag, do this. If you no, they are built to understand data. They are built to understand market, like data coming in, news events, and then make a decision based on that, regardless of whether you are drawing a trend line there or that. So they are not interested in that. They are interested in fundamentals. They are moved towards the direction of fundamentals. So that is why we always say fundamentals is what is the most basic requirement for a foreign exchange market. Now, let's go back. Let's go back, and then I want you to look at how much is being moved in this market on a daily basis. $7.5 trillion. Now you think the market or this amount of money moves because there is a line or whatever? Don't be silly. It doesn't. It doesn't. This market moves because there is a larger fundamental reason for it to move. Now we have, for instance, we have even if you look at the stock market and you look at some of the algorithms that were built in the stock market before, you would actually see that okay, there's this algorithm that what they were doing is that okay, if you see that a large institution is about to sell, the algorithm intercept the order and sell at a higher price to the other to the buyer or whatever. Now that is fundamental. That is not because of a line. It's all fundamentally driven. So like you have to understand that fundamentals move the market. These algorithms are fundamentally driven. They look at patterns. Now that is why I always say seasonality is very, very important. Why? Because there is a sequence of emotion that human beings go through. A very big sequence of emotions. Now in 1703, Gottfried von Leibniz commented to the Swiss scientist and mathematician Jacob Bernoulli that nature has established patterns originating in the return of events, but only for the most part. Now this led to the creation of the bell curve and then the discovery of standard deviation and all of that. Now I'm just trying to tell you that nature on its own has established patterns. So first of all, we have seasons. For instance, right here in Africa, we have the rainy season, we have the dry season. Abroad, we have the winter, we have the summer. There are things that happen during winter. During winter, everybody is indoor. Gas prices go up. During summer, oil prices go up because there's more utilization of oil, than gases. So all these things. Now, companies balance their books at the end of every quarter, at the end of every year. And all of that. So like you see these seasonal occurrences that occur, and then you see that people spend more approaching festive periods and all of that. So what happens? Retail sales are always going to like go up during times like that and all of that. So understanding these things, you are in a place where you understand that human beings are inevitably going to follow a particular cycle. So these algorithms, they study these cycles. They understand these cycles. They understand the cycles that human beings ought to go to or go through, inevitably go to. But if you look at this, you see that I said, but only for the most part. That is one of the most important aspects of this theory. It said nature has established patterns originating in the return of events, but only for the most part, which means there are always exceptionalities. Always exceptionalities. So, and if you read books like The 40 Laws of Power, you understand that every human being is predictable because of emotions. The more you put your emotions in check, the less predictable you become. So how does these algorithms, how are they able to actually be able to predict? They cannot predict in the absence of human emotions. Now that's why I actually want to compare YouTube, which is individualistic. It looks at your emotion, what you are interested in, and then it makes a predictive or a prediction for you based on your interest, your emotions. And you look at the foreign exchange market, these algorithms are also dependent on emotion. Now remove emotion, and then these algorithms are useless. And that is why they can never replace humans. Never. They can't replace humans. So you have to look at this thing from a standpoint that you understand what these algorithms are like. What are they built like? What is the purposes of this algorithm? What are they there for? And this is how you understand how you follow through. And you have to understand that human beings are cyclic. They follow a particular cycle. Now, there are exceptionalities, but only for the most part. Now, when a human being is in a balanced state of emotion, he is more predictable. Now, that does not mean that he's not also predictable at the extreme sides of his emotions. When we look at, the other side, which is excitement, other side, which is fear. That is the two extreme sides of emotions. When someone is overly excited, they act irrationally. When they are scared, they act irrationally. So these algorithms are not really able to predict irrationality, but they can predict rationality, because all things being equal, okay, from what we have noticed in history, this is where market is supposed to tag along. Now, reasons why hedge funds like Renaissance are not profitable for a while, because we're in a state of irrationality. Trump comes out and say this, oh, market is wild. Comes out and say that, so we're always operating in that level of irrationality. But when market is rational, it is highly predictable. So you have to understand, how does these algorithms work? What do they work with? Fundamentals, not patterns. Now you can talk about liquidity, but what is liquidity? What even drives the liquidity in the first place? What makes liquidity reside in a particular location? You say swing high, previous day low, this, that. What makes liquidity reside in those places? It's just fundamentals. That's a fundamental reason that market reacted from here to there. Today there was something that happened. Okay, why were you interested in the US involvement in the Iran-Israel war? If it was not important, why are you paying attention to what Trump has to say about tariff? Why do markets react so powerfully during this period? Why do you stay away or even see like a very sporadic move during CPI, FOMC, NFP? Why, if market is about patterns? Why are you not so profitable with your patterns and all of that? Why are you not? Why do you stay away when you know that market is going to experience irrationality because of a particular data? For instance, CPI, market will get so irrational, unpredictable. So you will not have the big money tagging along with you. Yes, and you have so much irrationality. And then when that rationality come out, these algorithms are actually small. These algorithms are actually going to tag along with the irrationality, and at a point they are going to exist and all of that. So you have to really understand how this algorithm works. What is the similarity? Now, case study, me using YouTube does not mean that it's only YouTube algorithm that works this way. You see, your Facebook, your Instagram, your X, these things, they operate with large language model algorithms. They're out there looking at patterns of psychological reaction towards events, towards data, towards news headlines. They are studying these things. So you have to understand how these algorithms move, how these big institutions move. And the big institutions don't have people clicking buys and sell for them. Nah, they use algorithms. So ICT was correct when he talks about algorithms moving the market. Don't be silly, don't argue that. It's just lack of intellect for you to argue that. Markets are totally driven by algorithms. In fact, we're in a generation where these algorithms are now highly utilized. Like your YouTube, and it keeps going. You have algorithms that, like, for instance, you are using your MacBook and then you come to a PDF and just pause for a while to look at what is there. Those algorithms will picture out or will take out the information there and then start advertising it for you. We have those algorithms. We have those algorithms that will see, oh, you said something like that or like this, and then the algorithm picks it up from maybe your app being connected to your mic, and then the algorithm goes and then fetches that particular ad and bring it to you to see. It's not human beings that are running these things, it's algorithm. It's also the algorithm that comes up like this and then look at, okay, or this particular data comes out, see how people are actually react to this data, and then you start reacting to that data in that particular way. So all these things are just algorithmically driven. Like it's not people pressing buttons and all of that. You get. So these are going to be like powerful series I'm going to release this period. I'm actually going to also explain to you guys why technical seems to work. Why does it seem to work? Like, we'll talk about traders bias and all of that. So hang on, subscribe, and then I promise you are going to learn a whole lot this period. After this series, I'm going to now explain more on my approaches to the market, and all of that, how to be very, very profitable in the market, how to understand, data, how to interpret data, news events and all of that. And then this will be your headway to profitability. Now forget all those nonsense you see out there. People are very, very lazy. People are very, very lazy. They don't want to actually go there, learn more, become better, and then utilize things that they learn. Everybody just want to draw something and then want to achieve profitability, and that's deceit. that's a whole lot of deceit. If it was easy, then everybody should have been, multi-millionaires and billionaires in this. So you can't tell me that it takes a bunch of people coming to draw lines to accumulate a trading volume of $7.5 trillion. Are you crazy to say that? Like, are you delulu? Nah. People are not the participants in this market. No, they don't look at lines. They don't look at this or that. Nah. So you have to actually be aware of what really moves your market. What even moves the general market of the world currently. Because social media are for advertisement and all of that. Like, what? How do they know what I like? How do they know what I've said? How do they push my content? How do I do things that people, if you can't be successful in YouTube if you don't understand the YouTube algorithm. You also can't be successful in trading if you don't understand how the algorithm works, how the market works, what moves the market, how does it move, how does it operate. I'm going to explain how markets utilize seasonality, how this algorithm utilizes seasonality, how they look at how market is crowded, look at behavioral patterns, which is also seasonality actually, yes. And then they actually look at this algorithm, look at market, the seasonality in the broader view, not like the way you look at these things. They look at it in the broader view. Like these things are like powerful machines. Like, oh god. Anyway, so let's call it a day here. Expect my next video after this. So like, I'm coming with bangers. I'm going to review things that people actually don't like to discuss, or people actually doesn't know. Now people actually can draw lines, and that's why I said why technical seems to work. Does it work? Yeah, some extent, but like you have to also understand that risk management is the key. Regardless, you understand, they will work, and all of that. But we'll get into that in details as we keep going. So thank you guys. More to come. Have a nice day.